All right, welcome everyone. Thank you for being here today with me. Today we're going to talk about what is likely to be one of the most important retirement decisions that you're ever going to make. What should you do with your retirement money, like a 401k, a 403b, or a similar plan once you leave your job? You know, a lot of people mistakenly think that this is an easy choice, but that's rarely the case. Depending on your particular situation, you may have up to six, yes, six different options to choose from. So today we're going to talk about each of these six options so that you can make the best decision for you and your family. We're also going to shed some light on some common mistakes so that hopefully you can avoid them. Hi, my name is Eric Hagan. I'm a small business owner. I'm president and I'm a wealth manager with Capital Consulting Group, Inc., or CCG. CCG consists of myself, Chief Investment Officer Tom Fox, financial advisors Dan Oshman and Rana Grant, and then our client support John Knutson and Marilyn Westmark. Together, we steward long-term relationships with our clients and work only for our clients. We are an independent firm. We are not owned by a bank, by an insurance company, or by some large financial institution. We are located in Eden Prairie, Minnesota, in the Twin Cities area. We serve people all over Minnesota, and with our 100% virtual advisor capabilities, we serve people all over the country as well. We can help you see your entire financial situation, both today as well as every year into the future through our personal wealth planning services. If you'd like to learn more about that after today's call, go to clearfinancialfuture.com, watch the 2-minute video, and we can give your life savings the attention it deserves with our Smart Mix personalized portfolio solution. Smart Mix is our personalized portfolio solution for individual investors. So with that, let's talk about the 6 rollover options that you have when you leave your job. Depending on your specific circumstance, you may be able to leave your employer plan assets in your existing company retirement plan, roll over your plan assets to a new company retirement plan, roll over your plan assets to an IRA, take a lump sum distribution of your plan balance, convert your plan assets to a Roth IRA, or make an in-plan Roth conversion of your plan assets. And in some cases, you may be able to combine some of the options on this list. For example, you might decide to convert some of your plan funds to a Roth IRA and roll the rest over to a traditional IRA. The first option and the most straightforward of the possibilities is to leave your retirement funds in your current plan. If you choose to do nothing, you are essentially choosing this option. Of course, there are a number of reasons why you might intentionally leave your money at your plan too. Most of you will have this option available to you. And there are a few times when a plan will force you to take a distribution. If you're lucky enough to be retiring early, or if you've otherwise left your former employer in the year you turned 55 or later, you can take penalty-free distributions from the plan sponsored by the company that you just left. This is different than the general rule, which says that you have to wait until 59 and a half to take penalty-free distributions. Once you're 59 and a half or older, this is no longer a concern. Similarly, certain federal, state, and local public safety workers can take penalty-free distributions from your plan at age 50 or later. If creditor protection is a significant concern for you, that's another reason it may make sense to keep your money at your plan. Certain plans, like most 401k plans, offer creditor protection under the Employee Retirement Income Security Act, a federal law known as ERISA for short. ERISA offers very strong creditor protection and safeguards covered funds from the reach of most creditors. On the other hand, IRAs, Roth IRAs, and plans that don't receive creditor protection under ERISA receive creditor protection under state law. Thankfully, most states provide these retirement funds with creditor protection that is roughly equivalent to the protection provided by ERISA, but that's not always the case. You should always be aware of the fees that you're paying in your current plan and the difference, if any, of the fees you'll be paying if you move your retirement money elsewhere. Fees vary greatly from plan to plan, but in some cases, your plan may offer certain investments at lower costs than you can get elsewhere. Of course, the opposite may too be true. A rollover to an IRA or other retirement account could help lower your fees. You simply have to look at these things on a case by case basis. And of course, it's important to consider the value you're receiving in conjunction with the fees that you're paying and not just the fees themselves. Of course, no solution is going to be perfect all of the time, and just leaving your money with your old employer is no exception. There are any number of reasons this might not make sense for you, some of which you can see here on the screen. Things like there are maybe more appropriate investments might be available elsewhere. More and or better service may be available elsewhere. Eligible designated beneficiaries may not be allowed to stretch distributions in the plan. Certain exceptions for the 10% early distribution penalty are only available in IRAs. Your plan may place certain restrictions on when you can take distributions of your funds. 20% of your distribution may be withheld for federal income taxes. Investment and or other fees may be higher than other options, and estate planning may be more difficult if your assets were moved elsewhere. Okay, so far we've talked about why it may make sense to keep your money in your current plan, but many people choose to move their plan money elsewhere after they leave their job, either to another plan or more commonly to an IRA. So before we talk about why that could make sense for you, let's talk about how to move retirement money. In general, there are two ways that you can move retirement money from your plan to another retirement account. You can either move it indirectly in what's known as a 60-day rollover, or you can move it right from your plan to your new retirement account in what's known as a direct rollover. A direct rollover is generally the best way to move your money. Let's take a look at why that's the case. In an indirect rollover, you receive a distribution of your plan funds payable to you, or they are sent to a non-retirement account. Then you have 60 days from the time you receive your distribution to get it back into another retirement account. Now, 60 days may sound like a long time, but it can go by in what seems like the blink of an eye. Let's face it, life happens and people get distracted, sick, or simply forget. And if that happens and you miss the 60-day deadline, the distribution is taxable, and depending on your age, it may be subject to an additional 10% penalty. Oops, sorry about that. Now, even if you're on top of things and you complete your rollover within the 60-day window, there's another problem with most indirect rollovers. When Congress created the plan distribution rules, they wanted to make sure people didn't take their money and run. So they created a special rule that requires plans to withhold 20% of taxable distributions that are payable to you when those distributions are eligible for rollover. For instance, let's say that you have $100,000 in your plan and you request a distribution for the entire amount. Your plan will actually send you a check for $80,000 and will withhold $20,000 of your balance for federal income taxes. Now, suppose you take the $80,000 and timely roll it over. Have you completed a full rollover of your plan distribution? No. Even though you only received $80,000 from your plan, $100,000 was actually distributed. If you want to complete a full rollover and avoid any taxes on your distribution, you'll have to both roll over the $80,000 you receive and make up the $20,000 withheld from your other savings. And what if you don't have $20,000 just lying around? Well, that's just too bad. And just imagine if your distribution is larger, say $500,000. Well, in that case, in order to complete a full rollover, you would have to come up with a whopping $100,000 to make up the amount withheld for income taxes. As you can see, there are some real problems with indirect rollovers. Thankfully, there's generally a better way to move your retirement money, and that's the direct rollover. In a direct rollover, your plan money is sent right from your plan to your new retirement account. Most importantly, there is no 60-day time limit to worry about, and there's no mandatory 20% withholding. Sometimes, though, a plan will not offer to send your money right to a new retirement account. They do, however, have to allow you to make a direct rollover. Typically, this is done by providing you with a check made payable to your new custodian, to your new account. For example, the check might read Company X, custodian, for the benefit of John Smith, IRA. If the check is made payable to your new custodian like this, your distribution can still qualify as a direct rollover and get the same favorable tax treatment. There is no 60-day deadline and no mandatory withholding. That's true even if your plan sends you the check and has you forward it to your new custodian. All right, now that we understand the different ways that you can move retirement money, let's go back to exploring your rollover options. If you go back to work for a new employer that also offers a retirement plan, you may be able to roll your old plan funds into your new plan. Note that plans don't have to allow rollovers from other plans. So if this is something that appeals to you, be sure to check with your new plan to see what the rules are. The reasons to roll your money to a new employer plan are generally the same reasons you might consider leaving money in your old plan, such as the potential for stronger creditor protection, the possibility of purchasing life insurance with plan funds, and the possibility of lower fees. If this sounds like a lot of maybes, it is. When it comes to plans, the tax code is often far more liberal than a plan's own rules, so a lot, as mentioned before, varies from plan to plan. In addition to the benefits we discussed before, there are a few other reasons why you might want to roll old plan funds into a new plan. One reason is if you need to take a loan from your retirement money. In some cases, you may be able to take a loan of up to $50,000 from your employer plan. In contrast, you cannot take a loan from an IRA. It's what's known as a prohibited transaction and comes with some very scary tax consequences. In fact, if you had $1 million in an IRA and borrowed just $1, your entire $1 million would be considered distributed and fully taxable to you. Another reason this could make sense is if you want to use your retirement money to purchase life insurance and your new plan allows for it. To be clear, this is where you purchase life insurance while your money is still inside of your plan. Life insurance is a prohibited investment for IRAs, so you cannot roll life insurance over to an IRA. A more practical reason that you may roll money from an old employer's plan into a new plan is simply to consolidate your accounts. Many people, particularly as they get closer to retirement, try to simplify their lives. Rolling over money from your old plan to a new plan means one less account statement to keep track of, one less beneficiary form to keep up to date, one less account to make sure the appropriate RMDs have been taken out from, and you get the point. Once again, this strategy is not for everyone. Since this is a very similar option to our first option, you'll notice that many of the potential disadvantages are the same as that slide that I showed you earlier. The third option that you have when you leave your plan, and one option that must be available to you, is a rollover to an IRA. This is the preferred option for many when they leave their employer for a variety of reasons. If you want, you can roll your funds over to an existing IRA. Alternatively, if you don't already have an IRA open, or if you would just like to move funds to a new account, you can open a new IRA and roll your plan funds there. Perhaps the most common reason people choose to roll over their plan funds to an IRA is to broaden their choice of investment options. Many plans restrict participants to a dozen or so choices. You may have experienced this in your own plan. While the investments offered by your plan may be sufficient for your needs, many retirement savers prefer to expand their investment options by rolling over their funds to an IRA. Once inside an IRA, there are very few restrictions as to what you can invest in. In fact, while your particular custodian may be more limiting, the tax code allows IRAs to invest in anything except life insurance, collectibles, and S Corp stock. And this can really help you tailor your retirement portfolio to your specific needs. Another common reason many retirees choose to roll over their planned funds to an IRA is to consolidate their retirement savings. A study released by the US Department of Labor reported that baby boomers born between 1957 and 1964 held, on average, a staggering 11.3 jobs between the ages of 18 and 46. Sure, it's unlikely that you have had 11 different employer plans, but you certainly could have participated in 2, 3, or more plans over the course of your working career. An IRA can serve as a convenient collection point for these plans, leaving you with fewer accounts to keep track of and watch over. IRAs oftentimes have more attractive withdrawal options than plans. With an IRA, for instance, you can generally request a distribution whenever you want one. If you leave your money in your old company plan or roll it over to a new one, you're stuck with the plan's rules. Your company might be flexible, but it might not. Another big difference between company plans and IRAs on the withdrawal end is that there is no mandatory 20% withholding on IRA distributions. With IRAs, you can elect to withhold 10% of your distribution for federal income taxes, any amount more than 10%, or if you want, you can even opt out of federal withholding altogether and have none of your IRA distribution withheld. Another nice thing about IRAs is that if you have more than one of them, you can calculate your RMD for each account, but take it from just one account. So for instance, if you have one account that you really like or that's earning a high rate of return and you want to leave it alone, and you have another account that you're less happy with, you can take the RMD for both IRAs from the one IRA account that you don't care for as much. That's not the case with most plans, though. The general rule for plans is that each plan's RMD must be calculated and distributed separately. There is an exception to this rule, however, if you have multiple 403Bs. Here's an example of how this might work. Suppose John has 3 IRAs and his RMDs for the 3 accounts are $5,000, $3,000, and $2,000 respectively. That's a total of $10,000 that needs to be withdrawn. John can take that $10,000 from any one IRA or any combination of his IRAs as he pleases. Jane, on the other hand, has 3 401ks. Her RMDs for the 3 accounts have been calculated and are $5,000, $3,000, and $2,000 respectively. That's a total of $10,000, just like John. The difference, however, is that in order to avoid penalties, Jane must take at least $5,000 from the first 401k, at least $3,000 from the second 401k, and at least $2,000 from the third 401k. She cannot combine the RMDs and take them from just one account like John can. Rolling over your planned funds to an IRA can also provide estate planning benefits, such as making it easier for beneficiaries after you're gone by consolidating accounts. On the other hand, in some cases, rolling your money over to an IRA can be beneficial for the opposite reason. Doing so may allow you to split your account into multiple accounts, each left to a different beneficiary. And that may be helpful in situations like the ones that you see here. Some plans may not accept certain beneficiaries, such as trusts. They may also not allow you to use customized beneficiary forms or allow your beneficiaries to utilize certain strategies, such as disclaimer planning. Rolling your planned funds over to an IRA that allows for these options can resolve the issue. Finally, we come to the last point that you see here, preserving the Stretch IRA. This is an incredibly important concept, but one that is often not understood. As you can see, there are a number of potential benefits of rolling your plan money over to an IRA. And to review, those benefits may include a broader array of investment options, more flexible distribution options, RMD aggregation across multiple IRAs, more estate planning flexibility, and a simpler process for beneficiaries to preserve the stretch. When it comes down to it, All of these things can really be summed up in one word: control. In general, an IRA simply gives you more control. But they're not perfect, as you can see here. There could be some downsides to making this move. All right, let's move on to our fourth option: simply taking the money out of your plan. This is often referred to as just cashing out your plan. In general, this is not a great idea because you'll have to add that distribution to your income for the year. You'll also lose the tax deferral on those funds. And remember, while your money is growing inside of a retirement account, you don't pay tax on any interest, dividends, or capital gains. Despite compelling reasons like these, an alarmingly high number of people still cash out their plan balances after they leave their employer. Excuse me. Now, I said it's generally not a good idea to cash out your plan, but that's not always the case. In fact, if you're lucky enough to have the right set of circumstances, cashing out your company plan might make a lot of sense. That's because there's a number of tax breaks, like the tax break for net unrealized appreciation, that can offer big tax savings. Before we talk about these strategies, though, let me first explain what a lump sum distribution is. A lump sum distribution from a company plan means that your entire plan balance is paid to you in 1 year. Your account balance must be zero by the end of the year. If not, it's not a lump sum distribution, and you won't be able to utilize the special lump sum distribution tax breaks. By the way, the year here is a calendar year, not 365 days. Your distribution also has to take place after you have what's known as a triggering event. There are four triggering events outlined by the tax code, and they are: number one, death, which really doesn't help out very much, but could allow your plan beneficiaries to take advantage of the special tax breaks that we're going to discuss. Number two, reaching age 59 and a half. Number three, separation from service, meaning you've retired, resigned, or otherwise left your former employer. Note that this triggering event is not available for self-employed persons. So if that's you, sorry, you cannot fire yourself to make this work. And then number four, if you are self-employed, however, disability is a triggering event. The definition of disability here is pretty restrictive, though, so you need to be very, very careful. All right, now that we understand what a lump sum distribution is, let's talk about these strategies. And we're going to start with NUA, since it's probably the most common. Sometimes company retirement plans, such as 401ks, allow you to invest your retirement money in your own employer's stock. For example, if you work for ABC Corp, your ABC Corp 401k might offer ABC Corp stock as an investment option. If you decide to make such an investment, then any gain that you earn on those shares inside the plan is known as net unrealized appreciation, or NUA, and is eligible for the special NUA tax break. At its heart, the NUA strategy is a tax move that, for a portion of your retirement savings, allows you to trade the ordinary income tax rates that you normally pay on retirement account distributions for long-term capital gains rates. Given today's tax rates, this can be a savings of up to 20%. So how exactly does this NUA thing work? Well, there are really just three important rules that need to be followed, and we've already discussed two of them. The first rule is that everything must come out of your plan in 1 calendar year, and the second is that the distribution must take place after a triggering event. The final requirement is that your shares of company stock must be distributed in kind to a taxable account, such as an individual or joint account. They are not rolled over to another plan account or IRA. That's a common mistake. And if you do that, you will irrevocably lose the ability to make an NUA transaction. If your head is spinning right about now, I would not blame you. NUA is a pretty powerful strategy, but as you can see, it's also fairly complicated. You're probably not going to remember all the rules that we just talked about, but that's okay. If all you take away from this part of the presentation today is that NUA is something you need to explore further, then you're still way ahead of most people. And if you're still not quite sure if it applies to you, let me simplify things by asking you two questions. Number one, do you have stock in the company that you worked for inside of your plan? If the answer is no, NUA is probably not something you need to concern yourself with. Number two, has the company stock that you purchased inside your plan appreciated or gone up in value significantly since it was purchased? If the answer here is no, then again, NUA probably is not something that you need to worry about. If, however, the answer to both of these questions is yes, NUA is something you need to seriously consider as a part of your planning. As a part of that planning, I'd strongly urge you to consult with a tax or financial advisor with specialized knowledge in this area. It's rare that company stock will be the only asset in your plan, and if that's the case, there are additional planning concerns that should be addressed. There are other special tax breaks available for lump sum distributions too, such as the 10-year averaging and pre-1974 capital gains elections. These are still lump sum distribution planning strategies, so the everything out in 1 year rule still applies. And I'm not going to spend much time here on these today because they don't apply to that many people, but I do want you to know that they exist in case one or both of them could be of benefit to you. Your takeaway here is that if you're eligible to take a lump sum distribution from your plan and you were born before 1936, or if you had money in your plan on December 31st, 1973, there could be additional tax breaks that you may qualify for. Before making your rollover decision, you should be sure to explore them. And of course, while these strategies can be extremely powerful in some situations, they're not for everyone. So here again are some reasons why this might not make sense for you. Okay, it's time to move on and talk about our fifth rollover option, a Roth IRA conversion. While this is certainly not going to be the best option for everyone, it is an option that everyone has, and it's one that everyone should consider. In a Roth IRA conversion, funds go from your plan to a Roth IRA. Now, it's very important to understand that this is a taxable event, meaning the amount that you convert will be added to your tax return for the year. For example, let's say that Jane has $100,000 in a traditional 401k and would like to convert it to a Roth IRA. We'll talk more about why she might want to do that here in a moment. If Jane moves forward with her Roth IRA conversion and converts her $100,000 plan balance, she'll have to add $100,000 of income to her tax return for the year, which will be taxable at whatever rate Jane happens to be at. Because this is a taxable event, it's always best to discuss this option with your tax and financial advisors beforehand. Now, at some point, you've probably heard that you should never pay taxes before you have to. That's a very traditional way of thinking, and while in many cases it may hold true for you, there are a number of reasons why you might consider a Roth conversion. First and foremost is the potential for tax-free distributions from the Roth IRA in the future. If you are over 59 and a half and you've had any Roth IRA for more than 5 years, then all distributions from any of your Roth IRAs will be tax-free. If you're over 59 and a half but have not had a Roth IRA for 5 years yet, you can still take out any of your converted amount tax-free anytime. If you're younger than 59 and a half, other rules apply. For instance, suppose that Jane is 60 years old when she converts $100,000 to her first Roth IRA, and it grows to $300,000 by the time she is 70. If Jane wants to, she can take a distribution of the entire $300,000 and it will all be tax and penalty free. If Jane had needed the money, let's say when she was 63 instead, which is within 5 years of opening up her Roth IRA, she still could have distributed up to $100,000 tax and penalty free. The potential tax-free nature of the Roth IRA may also provide you with additional benefits, such as a hedge against tax rates rising in the future. When it comes to your retirement, there are a lot of unknowns. What will the market do? What will inflation be like? What will your tax rate be? And so on. That last one, taxes, is a major concern for many retirees. A Roth IRA conversion can help manage that risk by paying taxes at today's known rates. If tax rates rise in the future, tax-free distributions from Roth IRAs will be even more valuable. Of course, if you think your tax rate will be lower in retirement, well, then that would be an indication that maybe this strategy is not right for you. Also, since Roth IRA distributions in retirement are generally tax-free, they typically don't impact other things tied to your income. For instance, unlike supposedly tax-free municipal bond interest, tax-free Roth IRA distributions are not included in the calculation that determines how much of your Social Security income is taxable. So they can help to minimize that expense. They can also help you keep other costs tied to your income lower, such as your Medicare Part B premiums. Another big benefit of the Roth IRA, and one that many retirees find attractive, is that Roth IRAs have no required minimum distributions during your lifetime. So during your retirement, you can take as much or as little as you want. You're not forced to take anything at 72 if you don't want to, like you are with your traditional IRAs or your employer plans. That means your Roth IRA can continue to grow and compound tax-free for your heirs. That makes the Roth IRA a very intriguing vehicle from an estate planning perspective. And speaking of your beneficiaries, non-spouse beneficiaries like children do have RMDs from inherited Roth IRA accounts, but those distributions will generally be tax-free as well. Remember our Stretch IRA example from earlier? Now imagine if all of that was tax-free. You probably know what I'm about to say, right? Well, that's right. Just like everything else that we've talked about today, this strategy, as you can see here, this list of items, is not a right fit for everyone. You need to consider your personal, unique situation. All right, we've come to our sixth and final option, an in-plan Roth conversion. This is a relatively new option and is probably not available to all of you, but you should be aware of it just in case it applies to your particular situation. An in-plan Roth conversion is similar to a Roth IRA conversion in that you take pre-tax money, pay tax on it, and then have it in an account growing potentially tax-free for future use in retirement. The difference is that the conversion is made from the traditional side of your company plan to the Roth side of your plan. For example, if you have a 401k that allows in-plan conversions, converted funds would go into your Roth 401k account, not a Roth IRA. From a tax perspective, the impact on your tax return from a Roth IRA conversion and an in-plan Roth conversion are pretty much the same. You have to add the amount that you convert from your income for that year, and if you meet certain guidelines, future distributions in retirement will be tax-free. So if you decide to make an in-plan Roth conversion after you retire, you're really making two choices. First, you're deciding that a Roth conversion makes sense for your tax planning over the long term. We've already discussed why that might be. And second, you're deciding you're better off keeping your money in your plan than you are moving it to a Roth IRA. If both of these statements are not true, one of the other 5 options that we've discussed today is probably a better choice for you. There are also some distinct disadvantages of in-plan Roth conversions compared to Roth IRA conversions. If some of these are important to you, but you want to make a Roth conversion, you may be better off converting to a Roth IRA instead of an in-plan Roth conversion. Perhaps the biggest drawback of the in-plan conversion compared to a Roth IRA conversion is that there is no way to recharacterize the conversion. So if your tax bill is higher than expected, or your account value has dropped significantly since the conversion, or if you've otherwise changed your mind, too bad. you're stuck with your in-plan conversion and the resulting tax bill. Another big disadvantage of an in-plan conversion is that even after the conversion, minimum distributions are generally still required once you reach age 72. One of the major reasons many people consider Roth conversions in the first place is to avoid RMDs and to allow their money to compound tax-free throughout their lifetime. And that's generally not going to be the case with an in-plan conversion, though. So if avoiding RMDs is important to you, a Roth IRA conversion may be a better solution for you. All right, I promise this is the last time I'm going to say this today. The strategy is not right for everyone, and it comes with its own unique set of drawbacks, as you can see here on this screen. And as you've probably realized by this point, the decision of what to do with the money that you've accumulated in your employer plan is a lot more complicated than most people realize. Let's face it, your retirement plan assets likely represent years and possibly a lifetime's worth of saving. Now is the time to protect and preserve those hard-earned assets, and that starts with making the right rollover decision. Few retirees are aware of all the potential options. Even fewer are aware of all the key issues surrounding those options. So you're already ahead of the game. Hopefully, we've helped answer some questions for you here today, but chances are you probably still have others, and that's okay. Just a reminder, we are here to help. I hope that you found today's message educational. If you would like to discuss your situation, your personal situation, one-on-one, please look me up at www.schedulewitheric.com. We can answer your important questions. We can look at and evaluate your rollover options. We can move your retirement account money, if that's the right move for you, correctly to avoid costly mistakes. We can create a plan to tax efficiently, diversify, and liquidate shares of appreciated employer stock. We can create a tax efficient Roth conversion plan and much more. So with that, again, look me up at www.schedulewitheric.com, and I will close with another thank you. And thank you for joining me, and the best of luck with your continued